largest wealth transfer that we've ever seen, in my opinion, has happened over the last 15 years, number one. And number two, if the pain from the downside correction is as big as I think it will be, it wouldn't have been worth it. Hello, everybody. It's Mike Preston at New Harbor Financial Group. It's Thursday, April 18th, 2024. The purpose of these videos is to give you some data and some insight that hopefully can help you cut through the clutter, cut through the constant spin that you get all the time on the financial news, and give you some information that you can use. And if nothing else, hopefully makes you feel a little bit more secure and a little bit more relaxed. Don't forget to subscribe to our channel. We really appreciate it when you subscribe and when you comment on the videos. And lastly, reach out to us at any time, whether you're a client or just want to talk. There's a link in the bio down below that you can go to and then click, and it brings you right to our webpage. We're happy to have a conversation with you. We're happy to do a free review. Stick around to the end of this video, because today I'm going to be talking about essentially a market update. The S&P 500 has pulled back. A lot of people are wondering if the top is in or if this is an opportunity. But I also really want to put a spotlight on gold, silver, and the miners. So stay tuned for that. But first, New Harbor is going to the West Coast. Most of our team is going to go out to the West Coast on May 16th in Los Angeles and May 17th in San Francisco. We're doing a roadshow, and we're inviting all of our clients. We're inviting basically all of our listeners, all of our followers, all of our viewers, whether you're a client or not. We hope to see you there. Take a look at the bio below, click on the link, and please do register for that. If you're feeling confused by all of this, you're definitely not alone. If you're feeling scared that the market's going to crash, you're not alone. And let me go on record. I do think the market's going to crash, but I don't know when. I really don't. And we here at New Harbor are doing our best to try to make the journey more comfortable. We're trying to get a little bit of a gain along the way, and while not having much exposure to downside crash. We think that the stock market is insanely overvalued. It has been for over 10 years. And now the Federal Reserve seems to be permanently at post and make sure the market never gets to correct. We haven't really seen any great corrections that have stuck over the last 20 years now, almost 25. But we think that we're in the end game. We think that we're near the climax of a fourth turning in the next 5 years. So a lot of things are going to change. The thing is, we don't know when. This is very, very psychological. That's the tool that the Federal Reserve and other central banks have used basically to get their way, to extend our way of life, to kick the can down the road a little bit more. Now, some would say, hey, that's a great thing. We didn't have to worry about it. We got to continue to live the way that we wanted to live for longer. How is that a bad thing? Well, it's a bad thing because ultimately, well, two things. The largest wealth transfer that we've ever seen, in my opinion, has happened over the last 15 years, number one. And number two, if the pain from the downside correction is as big as I think it will be, it wouldn't have been worth it. It just wouldn't have been worth it. So A, it's not fair with the wealth disparity, and B, it just wasn't worth it. So let's talk a little bit here about a few different things. First, I want to cover this market pullback. Is it the top? Have we seen the top? Is this an opportunity to buy? Well, let me first say that I don't really think the top is in yet. We can't say for sure. Take a look at the S&P 500 here. This is a chart on a monthly basis. This has been an insane move in the last 15 years. I think we can all agree. And the market has tried to correct many times, but it hasn't been able to. Since last October, it's been a pretty straight up move. 1, 2, 3, 4, 5 straight months. This month here, being April, has been the first down month, and the month isn't even over yet, so we don't even know if it will be down. But if I go to the daily chart, this has been, basically 5 straight down days here. We've cut through the 50-day moving average pretty solidly. The 200-day moving average is down here. We're down around 4 or 5% from the top. The NASDAQ has been a little bit more hit than the S&P 500 has been. This is the NASDAQ, but overall, it's only about 5% either way that you look at it. So is this an opportunity? I have to say that for most people, this is not an opportunity, because I think the market is going eventually a lot lower. And I will go on record to say that fair value, if you look at earnings, assuming that the gross domestic product does not explode upwards, which I don't think it can, given the backdrop and the fact that corporations are getting around 12% profit margins right now when the long-term average is 6 to 8%. I don't believe that gross domestic product will explode upwards. I think it's likely to actually contract. But even if GDP stays the same, we're not going to get bailed out by growth. And so we should be down below 2,000, to be honest. Down in the 16 to 1,800 range would give us expected returns of 10%. Now, that may sound insane to talk about a 70 to 80% pullback. I certainly can't say that that's going to happen. I can't say that that will happen, but I can say that if that happens, you can then expect a 10 to 12% return on the S&P 500. And frankly, given that we're at a climax of a fourth turning and that we're likely to see tumultuous times ahead, I do think we're going to likely see sub 2,000 in the years ahead. I believe we're going to see a situation where the Fed fails. And when the realization happens and a moment of justice happens that says, you know what, there's no free lunch. We'll see. We will see. But having said all of that, I still don't think the top is in. Why? We haven't seen fear of missing out. We haven't seen anything other than a brief pullback here. Now, having said that, we're not willing to bet that that wasn't the top back here at 52, 64, 85. It might very well have been. We're holding right at 5,000 right now. We closed at 5,011. My belief is that we haven't seen fear of missing out. We haven't seen a vertical move. We haven't seen panic in. We haven't seen people panic in. And at this point, I think that's almost got to happen. This thing has been so big, so long, so many times that we have basically come back and we have what looks like a double top here. So the bears will say, well, look, here's a double top. Let's get in. My opinion is that this thing gets reversed and we do get FOMO over the next few months and we get a big move up. Again, we haven't bet anything on that. We have taken the opportunity to continue to raise our hedges. We have an S&P 500 put option on 10 to 15% of portfolios, and it started way down here below 4,000 a bunch of months ago. But we keep moving it up and up and up. We've just recently used this strength to move it up to 4,900. So this little bit of deductible here on this 15% of portfolio does have to be paid. But if we were to get a crash here, let's say, or a big drop, 15% notional of the portfolio would come right off the table. That's what we keep doing. I believe we're going to go higher. If I had to guess, I'd say August or so, we go up to 5,600 to maybe 6,000 on the S&P. But if we start to see an acceleration down, some of our roughly 40% exposure will come right off the table. We've got a lot of tools to bring in option premium. I can't say that there'll be no downside exposure, but it's going to be a small fraction of what the market can do. So we don't have to know. That's important. So a number of different things are going to lay the table or set the table for what happens going forward. Netflix just reported tonight, one of the FANG stocks. And so far, if we look at a very fast chart, it looks like it disappointed a little bit. So Netflix looks to be down about 2-3% after market. Nvidia, which is probably the biggest bubble stock of all, has had a massive run year to date. It's gone sideways. A lot of people think maybe, hey, this is it. And it might very well be, but I'll tell you this is only a test of the 50-day moving average that we saw just today. And we bounced off that. It wouldn't be surprising to me to see Nvidia go higher and go well into the low, 1,000, 1,100 type thing. And that type of movement in these leaders will cause some more FOMO, in my opinion. Now, some of these things have broken down, like, for instance, Tesla. Tesla is a former leader. It's down at 150 or so. It continues to act very badly. But the big leaders like NVIDIA, Super Microcomputer, which is this one, have been bouncing pretty well off the 50-day moving averages. It wouldn't take much of an up day to put some of these leaders back in leadership position. We're keeping an eye on all of this. We actually added a small position in the Russell 2000 on this breakout up here. It was tightly hedged where this red line is. So at the moment, this position is back off the table, but it's a small position and it'll go right back on if we reverse up. If I move to a weekly chart on the Russell 2000, you can see this base, this breakout. The breakout has thus failed. We lost a small bit on this, but our hedge kicked in at this line right here, 202. So we can sit back and see how that plays out. Earlier in the video, I said we would talk about gold and silver, and we've been saying this for a long time. Gold and silver look fantastic. The charts look fantastic. We recommend that people have 5 to 10% of investable assets in gold and silver. I continue to believe that that makes sense, even with gold at $2,360 or so, $2,360, $2,380. I believe that gold's going to go to 2,500 pretty quickly. It might even go there in a week or so. And I think it could even shoot through and go right towards 3,000. If that happens, eventually we're going to get everybody in the same pool and we're going to get a big pullback. But that big pullback may only come to back to 2,500 or so. So I wouldn't play games with not having a position. If you want one, I would get one. And if you already have one, just sit tight. You're good. I'm going to share the chart again, just so we can review some of these charts together. Here's gold. I'm showing GLD because my chart package doesn't have actual gold spot. But if we take a look at the weekly chart of gold, once we broke through this consolidation level, this triple top, which is right around 2,000 or 2,100, we went straight up. We had a bit of a blow off last Friday, and if I go to the daily chart, you can see that a blow off top. But look over the last 3-4 days, gold is giving up almost nothing. So I believe that gold is going to go higher. I believe it's going to move to 2,500 before we see any meaningful pullback. If we take a look at the monthly chart of gold, this is the one we've been talking about. This old high at 2011 had a triple top test here. Triple tops don't usually hold. We were saying that, and boom, we took right off. So these are all-time highs. How long is that going to go on? I don't know. But my best guess is we go right to 2,500 and then maybe even overshoot to 3,000 before we pull back towards 2,500. Let's take a look at silver. The silver chart has been sleepy, but all of a sudden it's waking up. Here's a monthly chart of silver. To me, this is a more compressed chart even than gold. There's this triangle right here. And we had tried to break out so many times from this downtrend, and we kept hugging that downtrend line. And now, boom, gold has jumped up. And the spot price of gold tested $30 last Friday. I believe if we see a move through 30, we're going to go right up towards the old highs here. If we break through 30, and we could probably squeeze up towards 40. I'm not going to say we're going to break the old highs that soon, but I think you might be surprised at how fast silver can move up if that happens. And I'm not saying for people to panic in or buy too much. I'm just saying don't be too cute if you want to buy a little bit and don't have it. Just get a little bit. And I think you'd be happy down the road. Taking a look at gold stocks, it's been puzzling. They've been underperforming. Here's a triangle in GDX. This is an ETF that owns the large cap gold stocks. We have tried to break out of this downtrend and they've failed, and maybe some people think it's going to fail here. And it's possible that it might fail. And we've got an open mind for everything, but I don't think it's going to. I think the breakout on gold and silver is going to stick, and I think that gold stocks are going to play catch up. If you look at the distance of this basing pattern here and then added it to the breakout, you'd be somewhere up in the 50s on GDX. So yes, I admit it's been underperforming. There's a lot of fundamental reasons for that. But honestly, I do believe that gold stocks are going to climb a wall of worry here and maybe even break out fast with short covering. Take a look at the 10-year maturity. This goes back to 1950 or so. This is the 10-year bond. So back in 1950 or so, the 10-year bond was at 4%, and it trended up and hit a high of around 15% in the early 1980s. This is the time where a lot of viewers will remember money market rates hit 18%, mortgages hit the high teens. And that pinnacle there in 1980, up at 15% on the 10-year bond, it marked the beginning of a 40-year bull market in bonds. That means that for the next 40 years, interest rates went down. And that meant when interest rates go down, bond prices go up. So it's a bull market for bonds. And it's been a huge tailwind for our economy. It's been a huge, huge advantage to have this. I believe when productivity or growth started to be questionable in the late 90s, there were other things that were done to goose the economy. Like Alan Greenspan encouraged people to take money out of their homes. They turned homes into ATMs. That exacerbated the tech bubble in 1999. And that crash was only reinflated with more easy money, so on and so forth. And so it got really ridiculous over the last 15 years. We essentially hit almost zero on the 10-year yield. And we hit a point worldwide where almost 20 trillion, 18 to 20 trillion, I think, in sovereign debt traded at negative yields. So we had this era of ZIRP, zero interest rates, and even NIRP, negative interest rates. So everyone kind of went bananas psychologically. Investors collectively lost their minds. They didn't know what to do. So what did? They bid up stock prices, bid up home prices, and past COVID, we've seen just a ridiculous explosion, all of those things. A lot of people have been feeling locked out of the housing market and have been really psychologically stressed because of that. We talked to a lot of people about that. And if you feel that way, give us a call. We can help you, or at least not feel alone. But over to the right of the chart here, you'll see that we went from about a half a point in 2020 to about 5%. We had a higher 5%. This caused a crash in bond prices the last couple of years, and we presently reside at around 4.6%. So this is a long-term chart. The next chart's a little shorter. This is over the last couple of years, and this is a weekly chart of the U.S. Treasury Yield Index. As I said before, we went from about a half a point up to around 5% here. You can see 5%. Then we dropped to 3.8. And over the last few months, again, these are weekly bars, we have climbed back almost to 5% again. This is a roughly 68% retracement, actually closing in on 70% retracement. I believe that this is it. I don't think we're going to hit new highs, although we could. My guess, though, is that this is just a partial retracement and that we're going to start to roll over on these yields. There's no possible way that the Federal Reserve can continue to fund their debt with rates up like this. And I know that this is not an instantaneous thing, and it's only a small portion of the federal debt that's coming due each year, but it does have an effect as the debt is rolling and then reissued at these higher rates. It chews into productivity, it chews into GDP, and all the corporations are facing the same thing. My belief, and you have to have a belief in this business, right? Nobody knows for sure the future, but my belief is the 10-year yield is going to go back below 3%, maybe even below 2%. But I do believe it's going to go below 3%. That is going to be a tailwind for long-term bonds. And that's going to essentially help our position in TLT, which is long-term bonds, and will be really good to lock in rates. But nobody knows when this is going to happen. I believe it's going to happen after stock prices tumble. Stock prices still haven't tumbled, and I just said a little while ago that I think we're going to go even higher first. Take a look at this. I mentioned the federal public debt. Well, this I know has been going on almost our entire lifetimes, and we've become numb to it. But we're here at 34 trillion, and it's going up by 3 trillion a year. This is before we've even had a recession. Take a look at these gray bars. These are recessions. I don't even believe we had a recession during COVID. That was kind of a blink. We haven't had a real recession since 2008, 16 years. And even that recession, it's hard to say, was allowed to correct. It wasn't allowed to correct. It was rescued with over basically $16 trillion of worldwide money printing. This recession back in 2002 was rescued. So look at the chart. We used to have recessions. Now they're not allowed. They become shallower and shallower while everything else goes exponential. It's not sustainable. Again, we want to encourage you to take a look at the link in the bio. Click on the link, send us an email, and we're happy to have a free chat with you, whether you're a client or not. If you're feeling psychologically stressed, or if you just want to have a review of what's going on in your portfolio, if you want to talk about gold and silver, we're here for you. Don't forget, we have an event in Los Angeles, May 16th, and in San Francisco, May 17th. Click on the link in the bio to register for that. There's an early bird discount. It's only $59 a person. And don't forget to like this channel, subscribe to this channel, and comment about how you like these videos, and if you'd like to see them keep coming. Until next time, this is Mike Preston at New Harbor Financial Group. Goodbye.